Evening, ladies and gents. My name is Simon Brown, doing this, what's ultimately the end of the series, which ironically is run through lockdown. These were supposed to be happening live in Santon and then webcast at the same time. Hey, COVID-19 got in the way, so here we are. We're all sitting in our respective homes, I suppose. We're talking trading. We've done the think pieces. We did the sort of know your derivatives, understand how derivatives work. And now what we're doing this evening is we're finishing up with the managing risk in a sense and how to do that. You're welcome to drop questions. I'll get those on the fly as they're coming in. If they're not time sensitive, I'll park them for the end. Otherwise, I'll take them as we get to them. And this evening, managing risk. This is the most important part of trading. Discipline's critical, but really, if you're not managing risk, what are you being disciplined to really becomes the question. And I always start with this because it's true, and just to keep everyone aware that you can lose more money than you start with. And this isn't a legal issue. This is just a be careful issue. And today we're going to help you not lose more money than you started with. It's also to understand risk, because Stefan Hedden talks about this a lot. She's an ETF investor, but your concept of risk, what is risk? Risk is when the outcome is not as expected. And that's really all risk is. If you're expecting a certain outcome and something else happens, well, that's the risk, that you don't get what you expect. You know, you go to a restaurant, you order a chocolate milkshake. Risk is you get a strawberry milkshake. That's not a big risk, but it's absolutely there, can happen, has happened, no doubt. So what we need to do is get that outcome in our head. And what we can almost get to a point if we take that risk when the outcome is not as expected. If we're in a trade and we're saying, look, here's what the potential outcomes are, and we are, given good proper thought to that, well, suddenly that risk starts to mitigate away because we're managing it. Outcome is going to be, we'll sell at a profit, we'll take a predefined loss, and everything will be fine. So we can actually start to, almost in a sense, combat risk, take risk away from the process. But let's look at the 5 potential outcomes for any one trader. First outcome, small profit, small losses the second. Then you got a break-even trade, which would be your next. And then your final outcomes are big profit, and ultimately you're going to have big loss. Those are the possible 5 outcomes you would get in any one given trade. You used a random coin in a dart, you would get that distribution of potential outcomes. What we need to do as traders is make very sure that there are no big losses. If we can remove the big loss from the process, well, then that darkened coin is going to make us money. We'll get some small profits and losses. In fact, we get a lot of those. A couple of break-evens. We'll get some big profits. Not many of them, but a couple. And we won't have the corresponding big loss. That metric there, those 5 different outcomes, if we don't have the secret killers, which is costs, slippage, and spread, absent of those, in essence, your portfolio goes sideways. Truthfully, because of the cost, slippage, and spread, your portfolio will eke down to 0. If we can remove that big loss, everything changes. It just becomes a fundamentally different game. And if you've been trading for a bit, frankly, even if you've been trading for a while, you fully get what I mean when I say those big losses. You understand the risks of them. You understand how they happen. You understand the pain of them, not just to you emotionally, but the pain of the actual hits in your portfolio creates a serious pain in a portfolio. And it is real pain, both financially and emotionally. So we're going to be talking stop losses. Stop loss is a predefined level at which you get out of a trade, no questions asked. Predefined means you decide the stop loss strategy before you get in. You get in with a stop loss, and as the trade moves in your favor, you will adjust the stop loss accordingly. So that's your predefined. Stop loss means you get out, no questions asked. That's what that is. But we've all got that time. You took the stop. Stock went down to your stop, and it went to the moon without you. And that is imprinted into the back of our eyelids. We can't forget that time when, whatever it might have been, we took along on Sasol at 40 and our stop was 24 and we actioned the 24 stop and now Sasol's 140. And we're like, and that weakens our resolve for stop losses. But you know what? There's another time out there which we forget about. Remember the time you ignored it. So let's look at a trade here. There's a nice little blue candle, nice little breakout, boom, 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 little breakaway gap. Brilliant. You've entered the trade. You've placed yourself a stop loss in a fairly cunning position. The next day you can see the small little dot there, small little gap up even further. Trade's going lovely. Everything is wonderful. It starts to go a bit pear-shaped, but hey, You've got your stop loss, no worries, everything's great. Tags your stop loss, you're getting a bit sweaty, breaks it, but you're going to ignore it. And hey, look at that last candle. I mean, it's red, it's the wrong color, but, and then boom. Now, this happens to be the Sassel chart, but I could have pulled dozens of charts out of the equation. Ignoring stop losses does one thing quite simply. It devastates our accounts. Suddenly we're like, oh, no. I didn't buy this for a trade. I bought this for a long-term holding. And you've got all these long-term holdings in your portfolio, which are dogs, Tongaat, African Bank, which is now Phoenix, and I think delisting or delisted, Steinhoff, etc., etc., etc. If you don't have a stop loss, you end up holding far too many of these. And if you're in a geared position, ultimately you're going to get forced out, sort of that sort of point where you're just going to get closed out. Your broker's just going to say, look, you ran out of money. Time to move on. It's been real, but send more money is the short answer. So you absolutely have to have it. And what we need to do is stop remembering the time it went to the moon without you and start remembering this time. Remember the time you ignored the stop loss. My trading profit over the last 20 years, and I've been green every year for 20 years, is quite simply for one reason. I'm brilliant at executing on my stop loss. My positioning is so-so. In fact, I do dumb stop losses. I'll talk on them in a moment. But when my stop loss is triggered, every single time for 20 years, I have exited when my stop loss is triggered. And sometimes stop loss is there, I don't know, whatever, 25 Rand, and whatever it is I'm trading opens at 23 Rand, opens below my stop loss. What do? I get out. I take the money. I run for the hills. I don't like, well, I've missed the stop already. Let's see what happens. Because you know what happens. 23 becomes 21, becomes 15, becomes 10, becomes Steinhoff. You have to exit every time on the stop losses, no questions asked. And here's a great tweet I saw earlier today. In fact, I got two great tweets I found earlier today. Unprofitable traders are unprepared to take losses. They secretly crave certainty, hope, pray they won't lose. Profitable traders are open to all possibilities unconditionally. They trade to win. Comes back to the risk is the unexpected. If you're open to all possibilities, there's no risk, there's no fear, there's no greed. Everything is possible. If you're not prepared to take losses, you're going to have more of those than you can imagine, and ultimately, you're not going to become a trader because you're going to keep on busting out, and at some point, you're just going to give up. You're just going to decide that trading is just a silly idea, you can't do it, it's for the birds, and you're going to move on. So where do you place the stop loss? I'll stress it is not a perfect science, and you will get shaken out at some times. First rule is give your stop loss space. I see people buying into a 150 Rand share, and they put their stop loss at 147. And what's that? 2%. The ATR is like 3 Rand 50, and they're not even within the average true range. So you can use with the eye. And with the eye, in other words, you look at the chart and you decide on a space it's going to be. Below a recent low, maybe a breakout, a trend line. What I like to say is put a stop loss where it's not going to go. And I've got my Think Markets app open. We'll log on to that just now and we can look at some examples around what I mean by that. The problem with the eye is it can be biased at times. Can be biased, will be biased at times. We bring bias to our parties. That's everything we do is there's a cognitive bias somewhere lurking in the background, betraying us in a sense. So that's the risk of it, that bias. But it's way craftier, and I like the phrase where it will not go. You're taking a long position in a stock, an FX, a commodity, or whatever it might be, an index. You say to yourself, I'm saying this thing's going higher. Where's it not going to go? Where can it not go? Where is it impossible for this price to go? Well, put your stop loss there. Now you're saying to yourself, that might be miles away. Yeah, but give it some wiggle room. Unless you're doing, 1 minute, 5 minute charts or something, you want wiggle room. I mean, if you're trading in equity, your stop loss should be probably 8% away. Now, I know that starts to get scary, but we'll come to position size in a moment. But what it's saying to you is, where is it not going to go? And then if it goes there, it's easy to admit you were wrong. And write it down, not as stop loss. Write it down as where it won't go. And when it goes there, it's like, well, I didn't see that coming. Turns out I was wrong. Time for plan B. Plan B, exit the trade every time, nice and simply. So you can do it with the eye, and I'll come to some examples of that, and I'll give you some homework around that as well. You can also use technicals. halfway through a range, moving average crossover, 2 times average true range, price through moving average. Now, I like the 2 ATR. We've got a video on just one lap around a couple, in fact, 2 of them on using ATR as a stop loss. That's quite a nice strategy to use. If I say it can be done, and what I mean by that is that, like, the moving averages cross, but just below that is what has been a support line. In other words, it might be going to support and bouncing. I typically, I'm doing one of 2 stop losses. I'm doing the eyes, looking at it, eyeballing it, or I'm actually just running. When I'm trading index futures, particularly when I'm doing my morning scalping, I'm just doing a 100-point stop, 100-point trailing. And that's a dumb stop because it comes down to 100 points, and at 110 points, there might be a giant buyer, there might be a support line, etc., etc. But the speed and style I'm trading, I don't have time for that. So I just put the 100 points in, and it works. And, yesterday worked a charm. Today got stopped out, I think, at about 40 points down per contract. Yesterday made my 150 points per contract. And it's those swings and roundabouts. Is one better than the other? No. It's personal preference, it's system, it's what makes you comfortable, and it's what works for you. And that's what's hugely important is what is practically working for you, what makes sense to you, what fits into your system, what makes you comfortable and sleep at night. Those are the things that matter. When you get that part right, then it's all fine. Then there's absolutely no problems whatsoever. Then the question, when do you action the stop loss? Now, this is this is not usually something that comes up in the stop loss debate, but do you exit on a touch of your stop loss, or do you exit on a close through your stop loss? And here's what I mean. Your stop loss is $10. You're long. Share tags 10 Rand by 1 cent. Boom, you're out, end of story. Or do you say, no, I need it to close below 10 Rand. In other words, I'll wait for the end of the day, or maybe I exit the next day. And to my mind, it depends on that time frame. So if you're doing the touch, you might just be a sudden seller during the course of the day, particularly if you're in lower liquid instruments. Sudden seller pushes it down a bit, boom, you're stopped out, and then it recovers because now the seller is done. But also you've got different time frames. You're setting your stop loss on a daily chart, or perhaps even a weekly chart, but then you're exiting on an intraday, on a tick chart, essentially. So it's that different time frame that we also need to comprehend with. The problem with taking the close is, let's say your stop loss is 10 Rand, the touches 10 and you're out. The risk is touches 10 and it's off to the races. Close, hits 10, carries on going. Might close at 9.90, that's fine. Might close at 9 Rand. That's not so fine. Suddenly your stop loss has ended up being 2, 3, 4 times in size. You can manage that. Do your 2% rule, make it a 1% or a 0.5% or a 0.8%, whatever the case may be. But there certainly is risk there. What I like about it is, particularly because I'm a systems trader. So except for my Aussie morning stuff, my ZAR 40, I'm a systems trader. In other words, if I get a touch on a stop and then it's off to the races again, my system says, hey, you're still in this trade. In other words, I'm not going to get another signal for a while. So I like to close below. What I do then do, so like my lazy, the 15, 30, 60 moving average system that I do, I did on a close. Now that was ungeared, so I wasn't taking that pain and risk of gearing. So the ungeared certainly made it a lot easier in many senses. But what it also did, in a sense, was it gave me that wiggle room because I was using a weekly chart. So, I had the space. Sometimes it was a bit of a crazy week, Monday, Tuesday, but recovered by the end. And because it's ungeared, I had that more space to run into it. But what I've done with other systems which I've used, I said quite simply, okay, I've got my stop loss and I want to close below it, but I've almost got an emergency stop. So my stop is 10. But you know what, at 9.50 I'm exiting because I can't take more pain because frankly, it might go to 5. So that's an important question. And truthfully, most people are going to say, touch and I'm out. And if you're setting up a stop loss within your trading platform, then most definitely what's going to happen is it's going to do it on a touch. It's not going to say end of day or end of candle or whatever the case may be. And then hard or soft. Hard on your broker system. And that's my preferred way. When I trade my Aussie ZAR 40s in the morning, I put my stop into the system, I can now leave. There's plenty of liquidity, I'll get taken out, no worries whatsoever. Soft is where you say, you know what, send me an alert and I'll manage it. There's all sorts of risks with that. Your first risk is you don't get the alert because you're, I don't know, you're in gym swimming, or you're on an aeroplane, or your phone is battery's flat or something. Second risk is you get it, but you get it late. Third risk is you get it, you log on, and you say to yourself, no, I won't take that stop loss. I'll leave it. Yeah, terrible idea. To me, hard stops. Unless you're doing the close, in which case then you're managing different. But if you're not doing that, then you want the hard stop. There's a risk of volatility. And question coming through, one dealer, you're saying, sometimes it feels as if the market is coming down to my stop loss and then rushing off. So yeah, I mean, are there people out there, particularly when you're trading something like an index future or something, where gets a bit quiet? What do? They quickly rush the market down to a certain point where there might be stops, trigger those stops, buy the stock, off to the races. Does that happen? Sure it does. Whose fault is that? Well, yours, because you didn't hide your stop loss. You were playing hide and seek, but you were standing in front of the tree. If you're playing hide and seek, you stand behind the tree. You hide yourself, hide the stop loss. If your stops are being shaken out, it's because you got them in obvious places. Don't put them in an obvious place. Now, I know someone used to put them at the low of the previous day, except you would put it to the cent the low of the previous day. And he just moved it, and he moved it a little bit below that low of the previous day, and I forget his exact metric. I think he moved it 10 points lower than the previous low. Suddenly he was getting shaken out less. His stop loss was just in too obvious a place, and as a result, he was getting shaken a whole lot. The other question, folks say, but if I put my stop loss into the broker's system, they can see it and they will shake me out. No, your broker is not there to shake you out. And what most of the broker systems work is your stop loss sits in a database and it says, I've got a stop loss on the ZAR 40. Please send me ZAR 40 prices. Every time there's a ZAR...
Sorry, Apple Cash isn't available.
Now Siri wants to talk to me. And then every time there's a change in the price that you're monitoring, it just sends it to the database. It doesn't know what level is important. It just knows that someone cares about ZAR 40 and it's sending the price. And then when that stop loss database gets the right level, it's like, whoop, hang on, stop loss level triggers, sends it to market. If you're worried that your broker is shafting your stop losses, and either you're paranoid or you're paranoid and they're after you, in which case you need a better broker. Auto trail, so broadly, two ways to do it. Again, I put a 100-point trailing stop loss on. As the price moves in my favor, that stop loss steps up behind it. When the price reverses, stop loss stays in place. It doesn't move against you. It only moves in your favor. And that's always been my preferred. Moves higher as the trade goes in your direction, but careful of being too aggressive. The other one is fixed, which would be using ATL, would be using the eyeball method. You log on, you place your stop loss, you've put it in the system. It's a hard stop. It's in the system. Everything's great. At touch and fire, everything's good. But then you leave it there, and then you check the chart, whatever you're doing, daily, weekly, whatever, and then you revise it manually as and when you need. So like initially you're in at 10 and your stop loss is 9 Rand. And everything's good. And then the share moves up to 12 and you're like, new space. My stop loss is now, 10.72. And so you go as you move that stop loss up behind it, keeping it going. Pros to either. I mean, I like, and it comes back to very much whether you're doing touch or close, very much whether you're doing technicals or with the eye, whether you're going to do a trailing or a fixed. Your system will define that to you and tell you how to do it. And then the point is to practice. So open your Think Markets app, pick 100 charts, place a stop, check back in a week. How did the stop do? Place a new one, check back in another week, rinse and repeat. Try and do this. I find it especially useful if you do it on things you don't know. Go find some shares, indices, whatever, that you don't know what they are. Why? Because we've got no bias. I said it before. Chap I know who trades Singapore. Why Singapore? He knows nothing about it. You know what I love about the DAX? I don't know half the stocks in the DAX. Turns out Wirecard was in the DAX. I didn't know Wirecard existed. Now it's bankrupt, it's gone. I don't know half the stocks in the DAX. That's not true. I know less. I know none of them. You would think it would be the obvious ones, and some of them are, but it's all these companies you've never heard of. You don't know what they do. Heck, some of them are even US listed and not even listed in Europe. So it's try and find that. And I'm going to give some examples towards the end. When you're doing Q&A, I'll load up the Think Markets and we can go have a look-see and we can go and do some ideas of where I would be looking to be placing stop losses. But that brings me to the 2% rule. And another great tweet that came across my screens earlier today. Peter Brandt, as a trader for 45 years, same theme again and again. The demise of amateur traders is too much size. Greed motivates them to oversize trades. Adopting smaller sizing will improve long-term profitability. Trade smaller, do better. Why? Well, it seems contradictory. I don't think it seems contradictory, because if you trade too big, your stops are giant, but you're going to make mistakes. Emotionally, it's going to wreck you when you're in losing trades. What are we doing when we enter the trade? We're so busy focusing on the profit. Talked about the perfect trade. I'm going to talk about it again this evening. Forget the profit. Focus on discipline. Focus on position size. Focus on everything doing the right thing at the right time for the right reason. Keep your positions small. Your winners will add up. And then occasionally, lots of small winners, small losers, and occasionally that big winner, and that makes a fundamental difference. Particularly in a geared environment. If you're trading 10 times geared, and you get a 10% move, you've doubled your margin. And that gets real. That absolutely gets real. So that brings me to the 2% rule. Now, there's a lot of debate whether 2% is too aggressive. Some folks will say it should be 1. I typically run at around 0.8 to 1%. And what we're talking about is how much of your portfolio is at risk in any one trade. How much of your portfolio is at risk? Not where is your stop loss, portfolio. And it needs to be 2%. So if you've got a 100,000 Rand portfolio, 2% of that is 2,000 Rand. That means if you get stopped out, you lose 2,000 Rand. It also says to your head, remember that slide right up front. Risk is when your expectation doesn't happen. If your expectation is that, look, one or two things are going to happen. I'm going to enter this trade and I might lose 2,000 Rand. Yeah, so what? You know what? I've got 100. So I can do 50 trades before I bust out. Or I'm going to enter the trade and I'm going to make some money. Or maybe I'll lose 500. But you've got that expectation. You know what to expect. Now there's no fear. Now there's no worry. Mark Douglas in his Trading in the Zone, which I'm going to say again, book you've got to read if you want to be a trader. Mark Douglas, Trading in the Zone. What he talks about and what he says is, quite simply, is consider that 2%, that 2,000 Rand is the example I'm using. Use that. View it as the price of admission into the trade. You pay 2,000 Rand. You want to enter the trade? This is Market standing at the trade door. She says to you, price of entry, 2,000 Rand, please. You hand over the 2,000 Rand. You're now in the trade. At some point, the trade will conclude, and on the way out of the door, you will get a bag of money. That bag of money might be 500 bucks. And if you paid 2,000, you got 500, you lost money. But it could be 2,000, it could be 5,000, it could be 10,000. It's the price. It's like going to a movie. You pay for the movie ticket, you sit down in the movie, you wait, you watch it. You don't know if it's going to be good or bad. Yeah, you saw the reviews loved it, but you hated it. You don't go get your money back. It's that price that you've paid right up front. Question talking about 100 stop losses for practice. Do you actually place the trades? No, just drawing levels on the graph. Literally just putting the levels on the graph. And I'll show you examples in a bit. Put the levels on the graph, draw them in, save it, come back in a week, have a look. So not actually doing live trades, just drawing lines on charts where you think stop losses will go. So 2% rule is how much cash at risk, and never more than 2%. At 2%, and let's pretend truthfully, it would be logarithmic as you had a string of losing trades. But let's pretend math is simple and it's going to be linear. 2% means you can do 50 losing trades in a row before you bust out. 50 losing trades in a row before you have no money left. That is so much time to practice, to learn, to get to the skill. 50, I mean, my record for losing trades sits at about 13. And we're saying here you can have 50 in a row. Now, practically, you start to run out of cash, and if you're doing a 1%, it's 100, but you can certainly do 30-odd losing trades in a row. And the process is, you get the buy or sell signal, you determine your stop loss level. So tonight, after this presentation, you fire up your charts, you get a buy signal. What price will you be paying? Well, you don't know until the market opens, but you know your stop losses. So you position your stop loss. Tomorrow morning, you enter in the trade. Now you know where you're going to be entering. You discover that enter, and from that, you get your position size. Position size is how many do you buy. So, example, 50,000 Rand portfolio. 2% at risk, 1,000 Rand. Okay? That means you can lose 1,000 Rand in every trade that you do. Your entry price is 12 Rand, your stop loss is 11 Rand. You need the stop loss tonight, you get the entry price tomorrow morning. If you buy at 12 and are stopped at 11, your risk is 1 Rand per instrument. So you divide 1 Rand into 1,000 Rand, and you can go and buy 1,000, whatever it is. CFDs on an index, a commodity, a currency, an equity, whatever it is. You can buy 1,000 of them. And you buy 1,000 of them at 12 Rand. Exposure is 12,000 Rand, but your margin is going to be about 1,200 Rand because of a 10 times gearing. And if it falls to 11 Rand, you exit, and you've lost a Rand per 1,000, and you've lost $1,000. You've got 48,000 left, and you're still in business. Sorry, 49,000. My math is bad. 49,000 left, your portfolio is hardly hurt. Flip side goes from 12 to 15. Then it pulls back and you end up getting stopped at 14. You've made $2 a shot. You had 1,000 of them. You've made 2,000 Rand. Your portfolio is 52. And you see what I'm doing here as well, back to my first point with expectation. The expectation, if you have what the expectation is going to drive your fear and your risk. Let's look at another example. You've got a 10,000 Rand portfolio, which puts 2% to $200. Same trade, 12 Rand entry, 11 Rand stop, risk per trade. And there's an error on the my bad. Fix the error. You can risk 200 Rand. You can 1 Rand per. Therefore, you can take yourself 200 units. Nice and simple. Another example. Still 50,000 portfolio, 2% is 1 Rand. You're entering at 12, but this time you've got an 8 Rand stop loss. And you've got a giant 4 Rand stop loss, which is like, that's crazy. That's 30%, 33%. What are you doing? Well, maybe it's a very volatile market. So as the market gets more volatile, your stop loss stretches and your position size comes down. And that's perfect because volatile markets are more risky. And in that process, you're taking less risk. Still $1,000. Risk per instrument, 4 Rand, 1,000 Rand at risk, you can buy 250 of them. Maybe the market's deeply unvolatile. Maybe you're trading a breakout, so your stop is really, really tight. 12 Rand entry, 11 Rand, 50 stop. Risk per instrument, 50 cents. Divide that into your 1,000 Rand, you can go and buy 2,000 of them. Does this make sense? And I've used different portfolio sizes here. It'll work for any portfolio size. I've used 50, I've used 10, I referenced 100,000. That's just the math behind it. But this if you're not sure, ask the questions, because this is hugely important that we understand this. I'm not saying your stop loss is 2%. In this case, your stop loss is 50 cents on a 12 Rand trade. Running my math, that's about 4%. In this case, your stop loss was 30%. In this case, your stop loss was 8.5%. The actual percentage of the stop loss was all over the place. But the actual value that you traded was all over the place. But your risk every single time was 2% of your portfolio. Either 1,000 Rand in a 50,000 Rand portfolio, $200 in a 10,000 Rand portfolio, your risk is the same every single time. And what it means is when you've got different trades open, they've all got at the beginning the same risk. There's no favorites, there's no extra risk, there's no lazy trades. They might have different levels of stop losses, but they're all the same risk to your portfolio. And that is what is so hugely important. There are problems. The first one you picked up is that way, you're not going to double your money by the weekend. But here's the thing. You're not doubling your money by the weekend anyway. Let's be honest. Okay, and the chirp from Anonymous, unless you fold it over. Fair point. You want to double your money by the weekend, fold it over. That's exactly it. This is excluding costs, and that's one of the problems. I come to that in a sec. Small portfolio, if you've got 10,000, it starts to get a little bit wiggly. If you've got 5,000, it starts to get really tough. Less of an issue if the product you're trading has no minimums. Think markets, JSE, CFDs have no minimum brokerage, because otherwise the costs hurt you. Worse, as you say, costs become the issue. So I've done my 2% here. I've assumed that there's no costs on these trades. That is simply not true. I've also assumed there's no slippage. In other words, my stop is 11.50 and I'm out at 11.50. Now, that'll happen. Sometimes I might get 11.55. Sometimes I might get 11.40. So those costs are there. Now, how do we manage it? Well, the one way to do it is to drop down and instead of a 2% rule, use a 1% rule. In other words, all of these examples I give you, you actually trade half size. The other is to say, my entry is 12 Rand, but there's 50 cents of costs. So actually my entry is 12 Rand 50. Okay, that's a lot of cost. Let me make it 10 cents of costs. So my entry then becomes 12 Rand 10. And when I sell at 11.50, there's 10 cents of cost, so my exit becomes 11.40. So I've got an extra 10 cents on the entry, an extra 10 cents on the stop. That makes 70 cents. That means instead of 50 cents risk per trade, I'm at 70 cents risk per trade. 70 cents into 1,000 Rand, let's call that, it's about 1,650 instead of 2,000. I'm doing the math in my head, so don't sue me if I'm slightly out. But you get the sense. And you've slightly taken back the trade size to accommodate because there are fees. Because otherwise, that 2%, it's assuming you trade in a world of zero fees. So that's how you're going to manage that fee cost. Now, there are a couple of things. Firstly, a lot of you are thinking 2%. I wonder what happens if I try 3, 4, or 5. Well, here's what happens if you try 5. And you have 13 losing trades in a row. You've lost 65% of your portfolio. To get your portfolio back to where you started, you have to grow it by 200%. And imagine growing your portfolio 200% and you're only back at the beginning. The person who had 13 losing trades in a row and did 2%, they're at 74%. They've only lost a quarter of their portfolio. To get back to the beginning, they've got to grow it by 33%. So 5% sounds like ideal, but it's going to kill you. Even 3, 2% is absolutely the upper limit. And if I speak to the likes of Garth McKenzie's of the world, the sort of the pro traders out there, they're typically closer to 1%, in many cases 0.8%. Shane, number of trades, I'm going to come to that in a sec, because that's a great question. In terms of how many trades we should be doing at a time. Truthfully, what this means is that your trading is actually a lot of cash sitting there being lazy. I hear you. But if you sweat it too much, you're gonna take the pain. So then, Shane, to your question, we come to portfolio risk. And that's how many trades. So Elder talks about the 6% rule. Alexander Elder. Never have more than 6% of your portfolio at risk at any one given time. So you open 3 trades. Boom, boom, boom. Each trade is at 2% risk. Let's say that includes your cost structure as well. You're now effectively, your portfolio is at 6% risk. If each of those trades were to stop out immediately, you would lose 6%. So you don't ever take more than 6% of your portfolio at risk. 3 trades, you open them. They're all new trades, so they're all at 2%. Therefore, your risk is now 6%. You can't enter more trades. That's it. No more trades. But the trades will evolve over time. Some of them will close out. So you have 3 trades. One of them stops. You've now only got 2. So you've got the wiggle room to add a 3rd trade. But one of the trade moves into a profit. And in fact, the stop loss moves above your entry. Your entry was 12 Rand and your stop loss is now 12 Rand 50. Which means how much of your portfolio is at risk? 0. So you enter these 3 trades, and they're all winner trades. You've gone long of gold mines, just gold mines. Any gold mines, you bought gold mines. And you got into them, and they all ran up so brilliantly that you've moved the stop loss higher, and your stop losses are now all above your entry point. So you've still got those 3 trades. But portfolio at risk, 0. What's still at risk is profit. But it's paper profit. Portfolio at risk is now 0. So you've got 3 trades, but they are 0 risk trades. So your portfolio at risk is 0, so you can now add more trades. And if you were doing 1% per trade, well, then you could open 6 of them. And I've talked about this in some of the earlier videos we did with Think Markets. To me, 6 trades was too many. Look, I only trade 2 instruments these days, DAX and Aussie, the futures is R40. So it's moot for me. But if you're trading equity, particularly if you're doing, equities, commodities, maybe some FX, maybe offshore and the like, offshore and local, 3 open trades, you can get there quite quickly. But if you've got 10 open trades and all at 2% and something happens, a 9/11 or whatever the case may be, a COVID like we saw back in March, and markets suddenly collapse. You've got 10 open trades at 2% each. You can lose 20% of your portfolio overnight. Just boom, it's all gone. So use the older rule to manage the overall portfolio risk. And then you remember this story here, which I talked about in one of the earlier presentations, is what is your margin versus what is your overall. In this case here, you've got 60,000 exposure on a 20,000 Rand portfolio. In other words, your portfolio overall is geared 3 times, and I would say that is absolutely the max. So your first level is just good old-fashioned 2% rule, and that throttles your risk per trade. Then you throttle with the 6% rule, and you throttle that risk in terms of saying, cool, overall portfolio risk. And then you've got the third, because with ALDA, initially you start with 3 trades, but in time, if you just keep on buying gold stocks, you could have 10 open positions. Well, okay, there's a third rule which says, what is your overall portfolio gearing? Don't push that more than 3 times. So you're putting in layers of risk protection. 2%, 6%, 3 times for your portfolio overall. And all of that just means that it's reducing risk per individual trade. It's reducing overall portfolio risk to a calamitous event that, we might not have had any up until the beginning of this year, but we're currently living through one. And certainly they have happened over the years. And if you're trading individual stocks, let's say you have got 10 gold positions. And you wake up in the morning only to discover that, I don't know, China's decided to liquidate their entire gold position and they're going to be buying euros instead. And the gold price has collapsed $100 overnight and the gold miners are just cratering left, right, and center. This will keep you safe. And it's about being safe first, because when you lose your money, I know what happens. We almost treat it too much like the casino. You know what happens at the casino? You go there, you put some coins in, play the tables, whatever, you run out of money. First thing you say, where's my wallet? Turn to your partner, you got 200 bucks there for me. You treat trading the same. We bust out, no problem, we'll reload the portfolio. No, don't do that. I mean, truthfully, you probably are going to bust out. I bust out 3 times trading in the 90s. It was a long, lonely road to get to profitability. But you don't want to have to. How much better if you don't bust out? And then instead of reloading the portfolio, you're adding to the portfolio. You've got a winning portfolio. Your 20 grand's become 25 or 30. And then you find an extra 10 grand under the mattress and you're like, well, I don't have to start again. I can just add to a winning portfolio. Way better. So what are the fears that we have? I spoke about that one right up top. The first fear is just losing money. And there's a lot I've spoken about that this evening to manage that. The first is it's only 2% in any one given trade. It means 50 trades before you bust out. It's also, if you consider that money to be a ticket into the trade. Remember when I spoke about one of the earlier presentations in the Trader 101, when I said trading as a business. A business has costs, right? If you're selling hot dogs at the beachfront, what's your cost? Well, you need a cart to cart your hot dogs around in. You need napkins, you need hot dog rolls, you need hot dogs, the sausages, you need mustard, you need tomato sauce, serviettes, something to serve it in, a packet. Those are all the costs of the business. And in trading, you've got costs of the business, and one of those costs is the losing trades. And they're going to happen. And depending on your strategy, you might have more than others. Today, on my early morning Aussie trading, I lost money. Did it stress me? No, because it happens. I know it happens. I know I have a win rate. I know what it is. I know that losing trades are part of, trades that cost me money are part of what trading is. If the rand amount scares you, now, let's say you drop $1 million into your portfolio and now you're going to lose 20K a time. And you're like, 20K, I could get a second-hand car for that. Well, then reduce your percentage, reduce your portfolio. When I trade, I have discovered in my index trading, there comes a point at which I might have the capital to trade bigger, but I don't have the emotional wherewithal to trade bigger. Also, there's 2 issues. One is that I just start becoming too big and I'm moving the market. Only a little bit because my big is not big, but you get the sense. But the other is, it just comes a point where it's like, that many contracts for me, it plays with my head and I don't trade properly, so I keep below that level. And that's going to be different for everyone. Then, of course, perfect trades. Lewis, short-term treat you as a trader as opposed to investor, you pay tax. Yep, you will pay. So, quick little rabbit hole, let's pop down. What you're doing here is you are trading, and SARS will say this is in pursuit of income, and therefore it will get added to your income, and you will get taxed accordingly. Couple of things. Firstly, keep your trading and investing separately. So you're trading here, but you've got an investment account there. Okay, keep them separate so they're nice and clear. The second is, again, it's income. So what is ultimate income? Well, income actually, if you go through the SARS process, is actually money in less the costs in pursuit of that income gives you ultimate profit added to your taxability. So what are your costs? Well, your costs are brokerage fees, your costs are subscription to FinWeek, DSTV because you only watch Channel 412, you've never watched a soccer match in your life, subscription service maybe that you have, etc., etc. You could try claim a computer, but make sure you don't use the computer for anything else. You could try ditto with internet. You bought a book. You could claim that. I have a friend in Durban. We used to go for beers, and we would drink a vast amount of beers, and I would take the slip and I would claim it. Why? Because I met that friend on a chat forum exclusively for traders, and when me and him sat down, we would spend the first 10 minutes talking about the greatest rugby team in the world. That's the Sharks, right? The best part about webcasts is usually I get booed when I say that, but ain't no one booing, so it must be the Sharks. You all agreed. So we would talk about the greatest rugby team in the world for 10 minutes, and then we would honestly spend the next 5 hours talking markets. And I took that tab and I claimed it. And if SARS ever wanted to come and listen in, they were welcome because, don't scam it. But you've got your income, which is your profitable trades, less your costs, losing trades, etc., etc., etc. What's left gets declared to SARS, and you will pay, it'll get added to your income and paid at a marginal tax rate. If you make a loss in this year, you can't add a loss to your income. SARS is like, no. But you can ring fence that loss and park it into next year's profitable trading. So key trick, keep excellent records. Keep the best records possible because SARS is going to have questions. I am seeing chats coming through. Shane. Not a Stormers, hey? No, it can't be Stormers. Wouldn't be Stormers. Would never be Stormers. Perfect trade. We talked about this before. So this is how I mark every single one of my trades. In order to get, and my aim is not my aim, quite simply, I know I'm trading well when I get 7 out of 7. That's what I look for, 7 out of 7. Now, as I said before, two important points. You're welcome to take this and use it as you want. There's a video with a lot more detail you can go and find. Most important is make it to yourself. For me, I still think that in hindsight, and I did this 10 years ago in March, actually, so it's 10 years old. I think I would have been better maybe with 5 rather than 7. But decide what defines a perfect trade. And then every time you do a trade, mark yourself to it. Remember when we talked about discipline to perfect trades. Remember when we talked about goals. Your goal is to do 1 perfect trade, and then 2, and then 3, and then 4. And then tweet it, #perfect trade. There's a couple of folks, Njabul and Zabandi, Reagan, a couple of other folks who are out there who are currently tweeting their perfect trades. What matters here is you did the right thing at the right time for the right reason. You will note what is not mentioned here is did I make money? Because in any individual trade, making money is beyond your control. Everything on that list is something that you can control 100%. So in closing, and some homework, and it's the same homework I've been talking all the time. Set aside time every week for your learning. Engage your family as to when you'll do it and why you're doing it. Don't just disappear. This is going to take some time. And even when you pass the learning stage, you're going to need time to check charts. Are you going to do weekly charts? So you need a couple hours in a weekend. Daily charts. So you need an hour in the evening. When are you going to do it? Open a demo account. And there's 2 reasons to it. One is learn the platform, and 2 is practice stop losses. Start working with charts. Start trying different trading systems. And then ultimately, start trading. Always be learning. I've created a Twitter list. You can look for the most crazy URL in the world. Otherwise, find me on Twitter, Simon PB. Look under lists and you'll see the one that's called charts. And protecting capital is most important. Never ignore stops, never trade too large, and keep an eye on that overall portfolio risk. I know that stop losses are emotionally hard. Unfortunately, there is no hack for that. But we have to have them. And then let's head here. Folks, I'm hitting my time, but we can take some questions. So, show me charts. Let's pull out some charts. What are we looking at here? Euro USD. This is a daily chart candlestick. Where would I be putting my stop loss? So I can tell you now my preferred place where I would love to put a stop loss is all the way up there somewhere. Let me move that out of the way a bit. Let me move myself down to there for now. I'd love to put it up there somewhere. Truthfully, that's a fairly sneaky place. But that's 144. I mean, that is almost 4 cents away. That is absolutely giant. So where would I be looking to put it? Well, I'd probably be looking therefore somewhere around here, the 142 level. I would then also, that's an hourly chart, I would drop myself to a daily. Okay, I was assuming we're short. If we're short of this, then quite simply, I would be putting it somewhere that looks like a kangaroo tail forming on the daily chart. I'd put it halfway up that tab there. You drop to a weekly chart, whole different picture. If you're short at this point, maybe put it somewhere around there. See how much time frames matter. Lawrence, does Think Market have a demo account option? Yes, they do. You register up for the account, you got a demo account, nice and simple. What else have I got here? With the NASDAQ 100, we're looking at a weekly chart. Now, you would be long the NASDAQ, right? You wouldn't be anywhere else on the NASDAQ. Where would your stop be on the weekly chart? I would probably want it, well, so I don't have a mouse. So zooming on this is a little bit hits and misses for me. This week's been a bit crazy already, but we've pulled up. I would probably put it somewhere around the 10,250 level. Maybe at that point there, 10,150. Drop down to a daily chart. Nice and simple, 10,290. That's where I'd probably put it. If you're long of this, put it at 10,290. If you want to give it a lot of wiggle room, 9,680. It's about 10% away, which is a lot for an index-geared trade. And then there's another obvious one. Why am I picking that point there? So a couple of reasons. We've got, it's also just above that high there. It's also, there was a little bit there. It's also just at that point below that candle, which was a breakout, and it's also just below that candle wick there. So you can see a lot of activity happening at that level at 10,297. So drop it down. Let's not put it obvious, 10,250. It's about 4%. It's not bad for an index. What else should we look at? What have I got loaded here? Tesla. Yeah, so Tesla is practically impossible. This is a daily chart. Where do you put your Tesla stop? Probably at around 1350. You might want to, if you really want to put it, so if it gets towards that gap, it's going to start to close that gap. So you certainly don't want it anywhere near 1270. So therefore, that's 1310. I'll be looking at around 1330 for my stop. If you want a slightly more aggressive, you could put it at around 1380. What you are seeing here is that this is eyeballing. And when I'm saying go and draw them, save the charts and come back to them, you learn with experience. So you're looking at some of this and thinking that doesn't make sense. But you know what, as I said, go open a demo account and Think Markets, put in some stop losses, just open charts, record where you put your stop loss down, keep a notebook. What's the chart? What are the time frame you're looking at? Where did you put that stop loss and why? What was your thinking? And then do 100, come back in a week. How's it performed? What does it look like now? If you're short of Tesla, where's your stop loss? Excuse me, if you're short of Tesla, you're a brave person. Your stop loss is probably between 16 and 1650. If you really wanted to, you could put it halfway up that candle. But I think if we're getting back to the top of that candle body, we're probably going anyway. Sassel, So if you're long of Sasol, your stop loss is going to be around there, which is around 121. You might want to pull it back to 113. 113 is a bit far, so I would park it around the 121, 126 level. If you're short of Sasol, same theory, I'm putting it up just there. You see what I'm doing? I'm saying basically we can see where there's been activity, we can see where it's gone before, and what we've got here, and it's not perfect. I'm in a candlestick chart. Let me go to a line chart. What we can see, not the greatest visuals of it, but it's come down. We've had a high which breached the previous high. It's pulled back. We're now looking to make a higher high. We've got higher lows and higher highs. So suddenly now it's a case of, hey, maybe it's time to be taking a long here and putting your stop loss at around those levels. When I'm putting a stop loss in place, I always use candles because I think candles give me more insight. Correct position size, Ernst, that's your 2% rule. In other words, use your 2% rule to inform how many that you actually buy, so that we don't go rush off and buy, 1,000 when we should have bought 500, or we buy 1,000 when we should have bought 2,000. So 40. So if you're long of this, where's your stop? You could put your stop at about 50,350. It's also your time frames. If you're taking, if you're into a position and you're like trading and you're wanting to hold this for potentially weeks at a time, well, then you want to give more wiggle room, and then your stop loss starts to come down to 48,200. If you're more aggressive, you're placing your stop loss around the 50,300. Very aggressive, you can put it around 50,700. Drop into the weekly, see if there's anything that you're fundamentally missing here. What were we saying? 50,200 looks fairly decent for a stop loss. And then back at around about the 48 level for a longer, if you're looking for a much longer trade. Shane, demo trading for a week, placing trades over a week. I made my first profit for Aspen, 1,300. Nice, congrats. Let me go pull up the trade. So what did you do? You opened at 141, stop loss 120, profit 146. Total shares 350. So to me, the trick here, and I don't know how much capital you're using, is your stop loss was 21 rand, your profit was only 5. Your risk reward was you were risking 20 bucks, 21 bucks to make 5. Point being is you made the cash. Don't get me wrong, let's not knock it. Why did you pick 120 on a stop loss? 120 is a lot of wiggle room for a stop. This is still in a weekly chart. I would be looking for stops on Aspen probably around the 133-ish level. And if we look at a daily chart, yep, we're coming. You could even be aggressive at 139. I wouldn't enter at 140 for 139. I'm still at about the 131 to 133. So the question is, Shane, you were going long. Yes, you were going long. I mean, the short point is you made the profit. That's cool. You put your stop in. That's lacquer. I think you took your profit probably too early. And that's one of the issues, particularly with traders, is that, and I've been there. You got 2 trades, a winner and a loser. So which one do you close? Well, you close the winner because you want that hit of winning, and you run the loser. No, man, get rid of the loser. Let that winner run. At this point, though, I don't see anything that would make me want to buy Aspen. I would look either for a break below 140 or a break above 150. It's trading in a range, break either way. That would be the entry for me. Where's your target? So that range is 10 bucks. You're looking at about a 10 bucks profit, and then put your stop loss halfway through. So you're going to make 10, you risk 5. You always want your potential profit to be more than your potential loss, ideally 2 times the way. And if you're a pattern trader, chart patterns and the like, you've got those targets nice and simple. S&P 500. Daily chart. You are long. Where do you place your stop? You're probably putting your stop at around the 3120 level. DAX 30. When you're putting your stop, you're probably putting your stop around the 12,470 level. What we're seeing, and the charts are all coming more or less the same, is we've had a bit of a period of consolidation. We've broken out of some of it, and now we're starting to head higher. The exception, of course, is NASDAQ. Tech is the new flavor, absolutely. But what we're starting to see is those breaks are starting to come. What we're not yet doing is breaking that early June. 6, 7 June was when a lot of things were peaking, but we're certainly getting back to that level. Your entry point here would have been that big blue candle there. You can see a nice defined little pattern, sideways pattern that was forming between 12,440 and about 11,840. So about a 600 range. You've now got the breakout. Your target there for 600 points higher, which would take you to around 13,000, and your stop loss would be halfway down, so about 12,100. And the one thing, and it's the one guy on Twitter who I follow, he's on my list of chartists to follow. The thing that he keeps on driving home is twofold. The patterns will play out over the long time, and your profit, your trade, will potentially take days and weeks, if not months and quarters, maybe even years. Don't be in a hurry. Don't force it. Don't try and overdo it. Yeah, Shane, patience, risk reward, and patience. Some more questions coming through. Red one sent it to all panelists and attendees. If you trade lazy like me, it comes to technical analysis. Use Trading Central, free to clients who have live accounts for Think Markets. Log into Think Portal, and it's under Trading Tools. So Trading Central is really, really cool. And in essence, it's popping out ideas and stuff. In 2 weeks' time, we've got Think Markets doing another presentation as well on using the website. Let me go back to this one here. I don't want you there because then you're broadcasting to the world. We've got another event that is 29 July. Go to thinkmarkets.com, the address there, or drop them a mail. They're going to be talking about the research and stuff that they send out to clients. And I assume, everyone, you're going to touch on the Trading Central. Ladies and gents, I have run my time, and I've even run my backup time. My contact details, Think Markets contact details, legal disclaimers, we'll leave it there. All the videos that we've done, this is now the 9th in the series. You'll find it just justonelap.com/thinkmarkets. I learned today that the URL is case sensitive, and it must be a small t and a small m. I honestly didn't know that. I learned something new. Anyway, it's all there. You'll find me on Twitter. You'll find me on the emails. Chat to the folks at Think Markets. If you want questions, need support, anything like that. Shane, always a pleasure. Christo, absolute pleasure. Jacques, always a pleasure. Ladies and gents, we'll park it there. Everyone, stay safe. If you're in a cold part of the world, which I think many of us are, stay warm, wash your hands, wear your mask. Cheers all. Have a good evening further.